Yes, I bet. I'm going back to school, so I need to Oh, I do. The thing is, I grew up in high school. You know, I just find it. I don't solve. Yeah, I know. I like it. Yeah, I thought it. I'm gonna reject you.
It's okay. Okay, we'll get started now. We're doing this one broadcasting live. We have 19 viewers. Awesome. Hey, everybody. Let me turn the camera so they can see you guys. So I'm going to try about every other Thursday to have a session like this where we open it up to questions to people online and also in the class. And these are going to be focused on times where a project is due. So that's often where folks will have questions. Today, I'm going to do, we have 3 parts to our agenda. First part is I'm going to talk about my experience with Black Monday, so this recent Monday, and a trading opportunity that emerged Monday morning that I took advantage of, and it was really interesting. So I'm going to dive into the details about that. After that, I'm going to open things up to the audience, both online and offline, and just looking for questions about the class, about trading, about algorithms. I don't want detailed questions like when I run validate in.py, I get this 10-line long answer. What does it mean? That's for Piazza. Okay. Anyways, let me pause for a second. Can someone online ask a question? Tell me if you hear us okay. Online, ask a question. Hello, campus people. I guess you all can see that. Okay, great. Thanks. All right, so I'm going to show my screen so I can show some PowerPoint slides. Let's see if they work. Okay. Ooh. Okay, so this is probably not right. Okay. So for people online, when I try to show my slide presentation, it goes to another screen, and I'm afraid you might not be able to see it. So I'm just going to show PowerPoint like this and step through it a little bit at a time. Okay, so as most folks know, the stock exchanges in China have been really volatile. And going back to Monday morning, the Chinese exchanges had already closed for Monday. And does anybody recall how much they had gone down Monday morning? 8%. So everybody was very nervous in the U.S. that this problem was going to propagate, to our markets as well. Oh, and I didn't mention the third thing we're going to do after the Q&A session is help people install software. We might not be able to do that for the folks online, but we'll try to see if we can transfer screen shares. If not, we'll just terminate at that point. Anyways, so also, I guess a week before, China had also devalued their currency. So imagine that you are Apple, and you want to sell iPhones to one of the biggest markets in the world, namely China, right? If China devalues their currency, that means that suddenly iPhones cost more in China. And if you're a Chinese consumer and you're on the edge, should I get the Galaxy or the iPhone? Well, I guess they're affected by both, or something built inside China. Let's put it that way. Suddenly, other products seem more attractive, or you're less likely to want to spend your money. So suddenly, one of the hugest markets for Apple is degraded, essentially. But not just Apple, many other U.S. companies as well. So when you think about selling things from U.S. to China, that becomes a big problem. Now, what Apple countered is, oh, don't worry about that so much because we build the stuff in China in the first place. But still, it's a complex web. But anyways, these two things in combination put a lot of fear in the U.S. markets. And so when I was driving into work, I heard on the radio that U.S. futures, which sorry about the volume here. U.S. futures were indicating a lower open, like a significantly lower open. And what won't go into the details of futures, but they are instruments that are actually traded live before the market opens, and they're a very good predictor of what's going to happen at the open. In a moment, I'll get to a timeline of what happened in the morning, but I want to lay a little bit of groundwork first, because the opportunity arose in something called an ETF. Who knows what an ETF is? Raise your hand. So tell me what an ETF is.
It's an exchange traded fund.
Exchange traded fund. Okay, so how is it different from a stock, but like a stock?
You're getting with an ETF broad exposure to a certain sector or industry.
Right. There's lots of different things that you can trade on an exchange. Stocks, that's the basic one that everybody knows about. Mutual funds, which are managed by professional managers, but you can only trade those once a day at the end of the day. There's this other thing called an ETF, exchange traded fund, which you can trade all day just like a stock. And these ETFs came to exist in the 90s is when they became a big deal. So let's roll back time a little bit. In the 70s and 80s, the people who were doing research on market theory said, look, and we're gonna get into this in the second mini course, but they said, look, you can't win just picking one stock at a time and holding like 10 stocks. The best portfolio to have is the whole market, to own every single stock in the market. And in fact, there's this well-known index of the whole market called the S&P 500. Guess how many stocks are in the S&P 500? 500, yes. Except there's 501 today. Anybody know that? Anybody know why? No? Okay. Because, well, maybe a month ago, I'm not certain today. But anyways, Google split into two symbols, GOOG and GOOGL, and both of them were listed for a time and on S&P 500, so that's why there were 501. Anyways, the S&P 500 isn't just equally weighted. You know, you own, you would hold an equal amount of each stock. What it is weighted according to market capitalization. So Apple is maybe 4% of the S&P 500, and Exxon similar, and then all the way down to the lower weighted stocks. Okay, so in the 70s and 80s, this theory came out that said, hey, you should own the whole market, you shouldn't own individual stocks. Well, the thing is the individual investor couldn't very easily own all 500 stocks. So mutual funds arose, and what those were is managers said, hey, look, give me $10,000, and they would get $10,000 from lots of other investors, pool all that money, and then with that money, buy all the stocks in the S&P 500. So that's how you could, as a small investor, get access to the entire market. And then after a few more years, these exchange-traded funds came to exist, and they did the same thing. So there's this fund called SPY, which represents the whole S&P 500 market. And so if you buy one share of SPY, you get a little bit of all these 500 stocks. I'm going to take 1 second just to make sure our online guests are still here. Okay. Hey, everybody. Okay, you're still there. We'll get to questions in a little bit. Okay, so SPY is one of these exchange-traded funds. I'm not sure how much money is held by SPY, but it's huge. I think it's something like $150 billion. If anybody can go to Google Finance, tell me what the market cap of SPY is. Anyways, what is it?
19.5 trillion.
19.5 billion. So, huh? Trillion. Okay. Okay. That's a lot. You know, 1 or 2 billion, pretty soon you're talking about real money. Okay. So it's 19.5 trillion. So what that means is if you add up all the numbers of shares that people hold of SPY and multiply it by the current price, that's 19 point whatever trillion. So it is very, very, very actively traded. If you were to multiply how many shares were traded each day times the price, it's a lot. It's very, very, very liquid. But there are some other types of ETFs that are more targeted at specific things. So there's a group of ETFs that are targeted, for instance, at sectors. So you can buy an energy ETF that represents the energy sector. You can buy a transportation ETF that represents, and so on. And each of these more specialized ETFs have lower market cap. Could somebody look up the market cap for SPLV for me? So this is a permitted use of laptops in my classroom. While he's looking, 436 million. Okay, so what's 19 trillion divided by 436 million? Huh? 9,000? Okay, so long story short, even though when you're looking at your trading window or at Google Finance or whatever, and you're looking at the prices of these two ETFs change, keep in mind that for every dollar that's traded with SPLV, there's $9,000 traded with SPY. Or another way of viewing it is there's probably 9,000 more people trading SPY than are trading SPLV. Let me tell you what SPLV is. So it's SPLV is an ETF that I hold in one of my portfolios. And what they do is every quarter, they look at all of the S&P 500 and they pick the 100 lowest volatility stocks and buy them. So SPLV is invested in the same stocks that S&P 500 contains. So, you know, the core of U.S. economy stocks. It's just holding a different. It's holding 100 instead of 500, and it's holding some specific 100 instead of the whole market. Okay, so does everybody get me so far about these two ETFs? And yeah.
Are they deciding on like calculating most volatility, just like rolling 52?
Oh, right. So the question is for those online, how do they calculate the volatility? Actually, you can go look up their methodology. I believe it is that they simply look at the trailing 1 year daily standard deviation of daily returns over the last year, and take the mean for each stock. And the one that's lowest means it's the least volatile, and those are the ones they take.
You're saying they rebalance every month?
Every 3 months. Okay, so those are those two ETFs. Let's look a little bit more deeply at SPLV, because that's the one I was looking at. These are the top 10 holdings of SPLV. The main thing I want you to realize when you look at this is these aren't weird, freaky stocks. These are things like AT&T and Verizon and so on, Pepsi-Cola. I would never hold Pepsi-Cola though. Okay, anyways, that's because we're in Atlanta, right? Okay. Okay, so here's what happened Monday morning. So the red line here, which I'm going to reveal a little bit at a time, is the price trajectory of SPY, the S&P 500. The blue line is SPLV. So I can't show just the first minute, so you're seeing a little bit into the future there. But anyways, at 9:30, SPY opened. So that meant it began trading on New York Stock Exchange. SPLV had not opened yet. Now there's this complex set of things that happen before a stock or an ETF opened. And let me give you just a really brief summary of it. Before market open, people are allowed to put in orders. I want to buy SPY, I want to sell SPY. They can put in what are called limit orders. In other words, I want to sell SPY, but for no less than this. Or I want to buy SPY for no more than this. Those are the limit orders. We're going to talk a lot more detail about this later in the class. There are also a kind of order called market order, which is I just want to sell it or buy it at whatever the going price is. They run a calculation before they open the market, and they find the price that when we open will satisfy the most orders, and that's the opening price. And all those pending orders get filled, and boom, things start going forward. The trouble for SPLV was that they had lots and lots of sell orders, right? Because my grandma heard about all the scary stuff over the weekend and said, sell, sell, sell. So she's put in sell orders for SPLV. That they had way more sell orders than buy orders, and they didn't have enough of these limit orders to reach a satisfactory open. And furthermore, so there's this role called a market maker. So for each stock or each ETF at the major exchange, there's someone called a market maker, and they try to set these prices at the open. But things were so confused here, they didn't know what price to set. Eventually, like 2 or 3 minutes later, they did come up with initial buy and sell prices, but they opened late. So when a stock or an ETF opens late, that's always a bad sign. I've never heard of it being a good sign. Here's what things looked like by 10 o'clock. SPLV was down 42%, which is startling. The thing is, keep in mind, it contains the same stocks as SPY. In fact, arguably better stocks because they're less volatile. Yet this ETF had fallen 42%. So, and like I said, this is a major component of one of my portfolios, and I'm thinking, holy crap! I mean, really, sorry to curse, but I was worried. So I'm thinking, what's going on? I scan the news sources and so on and so on. And then it occurs to me, okay, maybe there's some weird stock in there that has fallen. I knew that on average the stocks had fallen 4%, but maybe there was like 1 or 2 in there that had fallen significantly. So I went and found what are the major holdings, and I looked at each one of those stocks individually, and they were each had only fallen 4%. We know that SPLV's real value should only be down 4%, but here it is down 42%. Okay, so who predicts that the price of SPLV is going to go up after you know this information? Okay, who thinks it's going to go down? Okay, we got the silent majority here. Okay, after I did these calculations, I felt I knew for sure SPLV is going to have to go back up. So at right about this time, I put in an order for $100,000 worth of SPLV at market. I didn't, well, as soon as I put that order in, they halted trading for SPLV. So if you look at these little horizontal spots there, those are places. So I don't know what the exact. I think it's if it drops 10%, they halt trading. So there's these built. They call them circuit breakers. There's these built-in circuit breakers where if it drops 10%, they halt trading for 5 minutes. One thing that allows is for people can still put in orders. So it allows them to put in limit orders so that there's some market depth is what it's called. Then they open up trading. So anyways, it fell 10%. They halted trading for 5 minutes. Open trading, it fell 10%. They halted it for 5 minutes. Kept repeating all the way down to 42. Anyways, I put in the market order right about here. I didn't actually get it until it had already come up this much. So I got SPLV at the point where it was 10% lower than it had been Friday, but I knew it was going to go all the way back up to 4%, right? Only 4% drop. So anyways, long story short, eventually SPLV came back just like it should against SPY, and I made $8,700, or 8.7%. I was nervous for a little while there, but of all the trades I've made, this one actually I was the most certain I would get the correct return on, because it just has to be that the value of SPLV is very, very close to SPY. It had to go back up. So this is what's called an arbitrage opportunity, where you look for mispricings like this. You know, if you know a fund manager is holding these certain stocks and the price of that fund doesn't add up, the more and more certain you are that, gee, it should really be this value, the more there is an opportunity for this sort of arbitrage. And there's lots of different kinds of arbitrage as well. Let me explain a little bit. We have a whole section on this in the next mini course, but I want to explain a little bit more of what happened there. So remember, there's these limit orders. People put in limit orders to buy and limit orders to sell, and when those orders can't be executed immediately, the exchanges sort of stuff them in a table. It's called the order book. So they know there's 1,000 people who want to buy it at a certain price, and 2,000 that want to sell it at a certain price. And the thing is this table continues down. So these funds sell in increments of pennies. So there's, for everyone, you know, the people want to sell at $99.99. They want to sell at 99.98, and so on. So for every penny, and there's, you how many orders there are for each one of these kept in this table. So imagine you've got this table filled, and a market order comes in. Let's say a market order to sell comes in. What happens is the exchange says, okay, somebody wants to sell 1,000 shares at market. So I will then, what they then do is they look at bids. So bids are people who want to buy, and asks are people who want to sell. So they find essentially the highest bid, because they want to give the best advantage to the person who's doing the market order. They take the highest bid and then match those two parties. And so that's how a sell happens. Well, imagine a huge sell order comes in. It'll wipe out sort of that first box of bidders. So some portion of those trades will happen with that box of bidders. Then the next one and the next one, and the price is going down each time, right? And so a huge order will suck up all those bins of people that are offering to buy the stock, and boom, the price goes down. And I kind of think about this order book as kind of like a wall. The more orders that are sitting in this order book, the harder it is to penetrate one way or the other. But if that gets swamped with huge market orders, it'll burst through that wall and blast down. And that's exactly what happened. So people weren't trading based on what the true value of SPLV was. They were just trying to sell, and the supply and demand took over, and the price diverged significantly from the true price. So, anyways, like I said, we'll have a session on this in the next mini course. Let me turn now to questions. And Alex, are you ready to? Okay, let me stop screen sharing. Okay, hey there, we're going to take questions now. So Alex is going to take a look at questions that are in Piazza, right, Alex?
Yes.
Okay, so we're going to alternate between online and offline. So we'll start out with a online question.
I don't know which ones are online.
But here, so someone said that they're a big fan of dividend stocks. And so are we touching dividend data in this course for analyzing stocks and portfolios? And I'm adding, if not, do you have any thoughts on dividends?
Okay, sure. So the question is, someone is a big fan of dividend stocks, and are we gonna touch upon that? So let me explain a little bit what that person means. Many companies pay dividends. So let's suppose you hold one share of Apple. They will several times a year pay you several dollars. I don't know what, probably the same person who was looking up market cap could tell us how much that is. But in any case, what happens is that cash goes into your account. And it's a lot like holding a bond. Like if you hold a bond, you can get a certain amount of return annually or so on. But of course, stocks are a little bit more risky. But in general, so one way people price stocks is they think about, okay, if I own this stock and they pay me $2 every quarter for infinity, how much is one share of this stock worth? So that's one way to value stocks. Anyways, to get to the question, we are going to talk about in the second part of the course how to value stocks according to dividends. We are not going to use high yield stocks or dividends as a sort of indicator for buying or selling. The one reason for that is we're focusing primarily on data that comes just from price and volume, and dividends are normally thought of as a fundamental, so they come from a different data source, and we don't have that data. I will say though that Yahoo does have that data, so you can download historical dividend payments from Yahoo. So you could build a strategy based on that using data that's easily available. Let me take a question from Atlanta. That means you guys.
So somebody ask a question.
Do you have a system in place that will notify you of, I guess, when these relative values get out of hand, or was it just you happen to see this at the right time? And,
Sure. So the question was, do we have a system for noticing when these things get out of whack? We do have strategies that look for arbitrage opportunities like this, but we work mostly with daily data. So this one would not have been noticed by our software, because by the end of the day, it had already returned to normal, and so we wouldn't have noticed it. So this sort of arbitrage opportunity would require intraday constant data. I just noticed it because every day I come in and I check the value of my portfolio, and sometimes it's down 0.5% or up 0.5%, and it was down, I think, 30%, and I was like, so that's how I noticed it. Any other Atlanta question? Okay, let's take a OMS question.
Okay, here's one. What are some methods of analyzing the risk of stocks?
What are some methods of analyzing the risk of stocks? That's a great question. We have a whole lesson on it in the next mini course, but I'll mention a few. So the classic one, what most financial people use to measure risk, is volatility. So they look historically at how much did the stock move around, and the more it moves around, the more risky they say it is. And it's typically, you take daily returns, how much did the stock price change each day, and you take the standard deviation of daily returns, and the bigger that number is, the more risky the stock is. There's more fundamental ways to look at risk. One example is instead of just saying, okay, what's the chance something bad is going to happen tomorrow, the volatility of the stock, you might say, suppose oil drops by $10, what's going to happen to this stock? So those are called exposures. So you can look at the stock's exposure to these different sorts of risks. Okay, any Atlanta question?
So when we looked at the SPLV, you saw that the value of SPLV kept dropping. Right? You said that this happens because there's a sudden void where a lot of the demand is fulfilled. So at that minimum value, is so when it hit the all-time low, yeah, at that point, does that mean that all of the demand was absorbed by the supply of stock? I mean, if people were selling, or?
So to repeat the question for folks online, he was asking about, I discussed how the price went down and down and down, and eventually hit this minimum point. And his question was, what caused the turnaround? It's a combination of things. The sort of the bottom line is I can't know for sure, but I believe a couple things happened. I believe that there are people who monitor when things get out of whack, specifically hedge funds, and I think a lot of people noticed that this couldn't stand, and they poured money in and bought it, and eventually. One reason you see this rapid return back up here is that's when people caught on to this mismatch and were buying as much as they could. So two parts of the answer. One, yes, I believe that eventually many of those orders were fulfilled, and two, a lot more volume came into that. And the fact that it came back up, is a perfect example of how markets work. It's got to come back up to this value. Otherwise, there's going to be somebody there to buy it and take advantage of that difference. Okay, online.
Okay, here's one that I'm wondering about, actually. Hello, just received What Hedge Funds Really Do in the mail today, and I'm looking over the event studies chapter. Read up on the efficient markets hypothesis, and I'm wondering, given the recent state of events in the market, if what I've been reading about using sentiment analysis from Twitter and other sources as a way of finding arbitrage points or detecting trends are bogus or not. And he cites two sources, two Twitter papers. Might be a silly question, but was wondering if Professor Balch had an opinion on this.
So I'm not certain exactly what the question is, but I think maybe, let me paraphrase it and see if you agree. Can I use Twitter as a sentiment indicator for buying and selling stocks?
Some kind of signal.
Right. Yeah, so I know of at least one hedge fund that was founded on the idea that you could monitor sentiment about stocks and use that as an indicator for buying and selling. I haven't heard much about it since it first came out, but my initial thought about it would be the following: that okay, who's posting on Twitter, right? My daughter and my son. Actually, they're on Instagram or no, what's that? I don't know, Snapchat. Anyways, they're posting pictures of their Nike shoes. I know that there's lots of other people who post, I guess Donald Trump also. But if you look at any information source, you have to figure out how can you map that information to a stock. For instance, you may be able via Twitter feeds to differentiate between Nikes and some other brand. You could measure how many posts are about Nike and how many posts are about another brand, and look for relative changes there. But I don't think that there's a lot of market coverage. In other words, there's probably not going to be posts about the steel mill. Or John Deere tractors. These are all very important components of the economy, so they're just not going to be covered by sources like that. Now, having said that, at my company, we have some sentiment feeds that are really effective. It's provided by a company called Raven Pack, and what they do is they give you each day for each company that they cover a measure of how many articles in the news were published about that company. And then they use natural language processing. They look at all those articles and they assess, were they generally good or generally bad. So they look for, keywords in the news article, say associated with Apple, and they say, okay, there was huge volume and it was generally bad. So that can be a bad sign for a particular stock. Okay, let me take one more question from here, from Atlanta, and then we'll start looking at installing software. Any Atlanta question? All right, let me take one more from on. Is there a good one from online?
There's an interesting one.
Okay.
Have you read the book A Random Walk Down Wall Street?
No.
It seems to raise the idea that picking stocks once based on historical performance is not a good indicator of future performance. It also suggests that technical analysis is pretty much useless. Instead, it's about low cost and diversified passive funds. Do you agree or disagree with these claims? And you sort of addressed that earlier.
Right. So a key, so this is famous book, A Random Walk Down Wall Street, and the key premise there was you really can't predict what's going to happen next. except when SPLV falls 42%. That one is a clear example. Well, so all this is based on this idea that you can't predict the future is based on the markets being perfectly efficient. And there's different levels of market efficiency. But I encounter over and over again examples where the market really isn't efficient. And those are where you find opportunities, is where pricing isn't quite right. Technical analysis, which is basically just looking at historical numbers, volume and price, is not as powerful at discovering these mispricings as some other techniques. But indeed, I've seen that it can. So, anyways, I don't think technical analysis is bogus. Okay, let's move on. Oh, question? Yes.
So, what's the accuracy of the models you have?
So the question is, what's the accuracy of the models that we have? That's a tough question because it's a little bit hard to say how do you measure the accuracy. But that's something we'll cover in the third part of this course. But I'll give you a general answer. Let's suppose you're trying to predict change in price. Let's say you're trying to predict change in price over 5 days. One way to measure the accuracy of your predictor is to look at the correlation between all of your different predictions and what actually happens. So a correlation of 1 means that your predictions are perfect. A correlation of 0 means that your predictions were essentially random. And then anything, well, if it were negative, it means you got it wrong. So most engineers or other people who study statistics, when they're looking at the correlation between things, they generally expect if there's a relationship, that the model is predictive, you should see a correlation of around 0.7 or 0.8, and that below that is kind of not useful. But we've created artificial data where we tested how high must that correlation be before you can start making money. Let's suppose we have and the way we do that is the following: is we have the pricing data, and we create a noisy fake predictor that knows what the future price is, but we add noise to it. You follow me so far? And then we use that fake predictor to trade, and we see how well it does. So anyways, getting back to this correlation thing. If your correlation is only 0.1, you can make an amazing amount of money. So what I'm saying is, if there's even just a teensy bit of information in there that's predictive, you can make a lot of money. A problem, though, is you have to overcome commissions and trading costs. So lots of times you'll actually have you'll have predictability better than like 0.1, but because your commissions cost you 0.2, you aren't able to make money. Anyways, long story short, our models have lots of different components, but they're on that edge of between 0.1 and 0.2 in terms of correlation between what they predict and what happens. Okay, all right, one more in the back there.
But to follow that there, what was the correlation that you saw needed before you make money after you count for trading?
Part of it depends on how frequently you can trade. So if it takes 90 days for that correlation to be revealed. That means you can only, trade once every 90 days. If it's revealed in 2 days, you can reap that profit and then make another bet. But anyways, kind of a rule of thumb is if you're trading on a weekly basis, you need about 0.12 to overcome trading costs. And if you're trading over a longer period, it has to be greater than that. Okay, we got to move to installation stuff. Brian, have you tried taking over the screen?
No, you have to assign that to us.
Okay.
We're both logged in.
Okay, you're both logged in. Okay, how do I do that?
I don't know. Arpin sent the instructions.
Oh. All right, so we might end up having to end our international broadcast. So let's just handle this locally.
Select his icon and then you click.
We're going to try to hand it over and see if it can work.
His icon at the bottom and then you click broadcast.
Let's see his icon. Oh, to the folks tuning in remotely, I see there's some additional questions there that we're probably not going to get to. They're good questions. Do me a favor and post them on Piazza under that Ask the Prof link, and I'll come on and answer them for you. So you're viewing.
There seems to be a sign that shows up. You mouse over that time. That might be the remote camera.
Okay, I think we don't know how to do it, so I'm gonna. Sorry, folks. We're gonna shut off the broadcast.